Hello and welcome to Investment Insight, your clear take on the markets. Let's get started. So today we're doing a deep dive into three really huge global economic stories that are all connected.
That's right.
These aren't just headlines. We're talking about deep structural shifts in, where risk is moving and where the next wave of growth might come from.
Absolutely.
First up, we've got the U.S. labor market. It's cooling down so fast that it's really challenging the Fed's whole game plan.
Now we're looking at China.
Yeah, where the slowdown seems to have become this structural crisis of confidence. It's hitting everything: consumption, real estate.
And finally, we pivot to this massive, almost symbolic deal where a huge amount of Japanese capital is making a long-term bet on India.
On India's consumer economy, specifically.
Yeah, right. And when you look at these three things together, the U.S. hitting the brakes, China stalling, and very conservative Japanese money picking India, it signals a real regime shift in the global economy.
A regime shift.
Yeah. The goal of this deep dive is to connect those dots so you walk away with a clear picture of what this means long term. For investing, for risk, for everything. We need to look past the day-to-day noise.
Okay, let's unpack this and let's start right here at home in the U.S. The analysis we looked at was really focused on the latest labor data. The headline unemployment number came in at 4.6%. I mean, historically, that doesn't sound like a disaster.
No, on its own it doesn't.
But the market reaction, the concern, it all came from the quality of the report. Let's talk about those downward revisions.
The revisions were the real shocker. They went back and pulled down the job numbers for October and November by almost 50,000.
50,000 jobs just gone.
Vanished from the previous reports. And what that means is the job market was slowing down way faster than anybody thought. And when you see that kind of sharp deceleration, your mind just snaps to one thing: the SAM rule.
The SAM rule. Okay. It sounds a bit intimidating, to be honest. For anyone who isn't tracking this daily, what exactly is this indicator? And why is it considered so reliable?
It's an empirical rule, and its historical track record is, frankly, fantastic for calling recessions.
Okay.
It's all about how quickly the job market unravels. The rule is, if the 3-month moving average of the unemployment rate goes up by half a percentage point.
Just half a percentage point.
Just half a point above its low from the last 12 months, a recession is probably already happening. The whole idea is that once the labor market starts to break, it doesn't usually just stop and turn around.
So our data shows we're right on the edge of that line. I love the analogy people use for this.
Yeah.
The SAM rule is like the check engine light in your car.
That is the perfect way to put it.
It doesn't mean the engine has exploded. Not yet. But it's a very loud signal that a serious systemic failure or recession is now highly, highly probable.
It's that preceding chill, not just a seasonal slowdown. And this sudden flash of the check engine light, it puts the Federal Reserve in a really, really difficult position.
I agree. I mean, just a few weeks ago, the feeling was the Fed did it. They stuck the soft landing.
Right, that was the story.
Now, after those revisions, the mood has completely shifted. The chatter is all, the Fed is behind the curve. They waited too long.
Precisely. And you can see that pressure building in market expectations. If you look at the FedWatch tool, the odds of more aggressive cuts, even a 50 basis point cut at the next meeting, those odds have surged to 40%. The Fed is being pushed to pivot, to stop being just the inflation fighter and go back to being the buffer for the economy, even if inflation isn't 100% dead.
And this leads to something really strange happening in the bond market, something you really need to understand. It's called bear steepening. We're all taught that when a recession is coming, rates are supposed to fall, right? All of them. So why are some falling while others are stuck?
This is where things get really fascinating, because the market is pricing in two completely contradictory futures at the same time.
Okay.
You're right. Normally, everything drops. But in a bear steepening, the short-term rates, the ones the Fed controls, are falling fast. The market expects them to cut aggressively to fight off a recession.
But the long-term rates, things like the 10-year Treasury, they're holding steady or even ticking up a little. What's causing that?
Long-term fear. The market is worried about two things. One, that all these aggressive short-term cuts will just reignite inflation later on.
So they'll have to raise rates again down the road.
Exactly. And two, just the sheer amount of government borrowing. The ballooning deficits mean they have to offer higher yield just to find buyers for all that debt. So you get this toxic mix of recession risk now and inflation and debt risk later. That's stagflationary risk.
So for the listener, why should you care about this weird bond market dynamic? What's the takeaway?
It puts a cap on the upside for long-term growth stocks. Think about those speculative tech companies that are valued on promises of future profits. If the market is saying long-term borrowing costs are going to stay high forever, it just crushes the valuation of those companies today.
So it forces a shift in strategy.
And a massive one. It forces investors to look for companies with cash flow and stability right now.
Okay, that is a huge shift. Let's use that idea of cooling U.S. demand as a bridge to our next story. China. And that structural transition you mentioned. The analysis we have confirms China's problems aren't just a temporary dip, it's a multifaceted slump.
And we have to stress that word, structural. A cyclical downturn is like needing an oil change for your car. A quick fix, some liquidity, a rate cut, and you're good.
Right.
A structural downturn is like finding out the foundation of your house is cracked. That's what we're seeing in China. And the data is just, it's stark.
So give us some of those numbers that really show the extent of the damage.
Let's start with investment. Fixed asset investment, or FAI. This is what companies spend on factories, on infrastructure. It recorded negative growth. Year over year, it dropped 2.6%.
Negative, so they're not just slowing down, they're actively investing less than last year.
They've stopped making big bets on the future. That's a huge red flag for confidence. And then you have consumption, which is barely alive.
What are the retail sales numbers looking like?
Up only 1.3% year over year. Outside of the pandemic lockdowns, that's incredibly low. And the key thing here is this isn't because people have no income. It's a change in behavior. People are saving, not spending. They're worried about their jobs, about the housing market.
You can't fix a confidence problem just by printing money.
You absolutely cannot. And all that uncertainty is anchored in the real estate sector. I mean, this is a quarter of their entire economy.
The numbers there must be even worse.
They're devastating. Real estate investment plunged 15.9% year over year. And that hits everything. Household wealth, since that's where most Chinese families have their savings.
Local governments that rely on land sales.
And, of course, the stability of the entire banking system. It's a threat to the whole house.
So, given that the foundation is cracking, what's Beijing doing? Are they trying to prop up that old model?
And this is the critical point. The analysis suggests a major policy shift. They're moving away from saving real estate at all costs and toward a new strategy of reducing reliance on real estate.
So they're accepting that the boom is over.
They're accepting that the sector's contribution to growth is going to be permanently smaller, which means any recovery will be capped. The fast growth days are done.
Now here's the paradox. Despite all this domestic weakness, China's exports are booming. The trade surplus hit a record $1 trillion.
That sounds like a strength, right?
It is a strength, a huge one. But it's become what we might call a political risk amplifier.
A political risk amplifier. Explain that.
That record success is creating a massive global backlash. Other countries are saying the trade is completely unbalanced and they're starting to push back. So that strength is now creating friction. And we're seeing concrete examples of this.
We are. You have French President Macron publicly calling out the unsustainable trade imbalance. That's Europe signaling its frustration. And more directly, you have Mexico passing a bill to raise tariffs up to 50% on certain Asian goods.
Which is clearly aimed at China.
It's a clear shot across the bow. So the key insight here for you, the investor, is that you have to start pricing in this political friction, tariffs, regulations, as a permanent cost of doing business in China's strongest sectors. EVs, solar, steel.
The stronger their exports get, the higher the political risk becomes.
Exactly. The old playbook where strong growth means easy profits.
Yeah.
That's over. It's much more complicated now.
Which brings us perfectly to our final segment, the counterpoint to China's slowdown, the strategic pivot to India. And we're talking about some of the oldest, most conservative money in the world, Japanese capital.
Right.
We're focusing on one huge deal. Mitsubishi UFJ Financial Group, or MUFG, is buying about a 20% stake in an Indian company called Shriram Finance. This is a $3.5 billion deal.
And it's a huge statement. The analysis really emphasizes that this isn't just a financial investment, looking for a quick profit.
This is a strategic alliance.
It's a long-term commitment. MUFG isn't just buying stock. They're getting a seat on the board. They're sharing risk management frameworks. They're connecting Shriram to global capital. It's a deep integration.
What's interesting to me is the regulatory reaction. Usually when a giant foreign bank comes in, there's a lot of pushback.
That's a great point. And what's remarkable here is that both the Japanese regulator, the FSA, and India's central bank, the RBI, are openly positive about it. They're calling it a long-term stable investment.
So they're welcoming it.
They are. They're distinguishing it from, say, a short-term private equity play. This is seen as permanent capital, which is a big deal.
But why Shriram Finance? Why is a huge global bank betting so big on what they call a non-banking financial company, an NBFC, that's so focused on local grassroots lending?
Because that's their in. Shriram is the local engine of Indian consumer finance. They have something like 3,000 branches dominating the semi-urban and rural markets.
An infrastructure you just can't build overnight.
Impossible. It's how you capture that ground-level growth in a country as massive and diverse as India.
So what are their specific strengths? I mean, lending in those areas sounds risky.
It can be, but they're masters of it. Three things stand out. First, they dominate vehicle finance, commercial trucks, two-wheelers.
Yeah.
That's directly tied to GDP growth.
The logistics of a growing economy.
Precisely. Second, they focus on things like gold-backed loans and small business finance for what India calls MSMEs. Those are sectors getting a lot of government support.
And the third thing?
Their data and their collection expertise. They operate in risky areas that big banks won't touch, but their data shows strong loan growth with very stable delinquency rates. They're challenging that old idea that India equals high risk.
They've cracked the code on local lending. Okay, so now let's flip it. What's the motivation for MUFG? What is Japan running from?
They're running from a triple threat at home. One, basically no growth. Two, shrinking profit margins because of zero interest rates. And three, the big one, a rapidly aging and shrinking population.
A demographic nightmare.
And India is the mere opposite. Explosive population growth, more people entering the formal financial system every day, and a huge expansion of digital data. For a Japanese bank, it's an escape hatch.
MUFG already had a corporate business in India, so what does this multi-billion-dollar investment actually buy them?
It buys them the consumer. It plugs that massive gap. Their priority here isn't just chasing yield. It's about market access and, crucially, data accumulation from the ground up.
So this is a defining moment.
It really is. The analysis confirms it. Japanese capital is no longer treating India as just another emerging market to play in. They've reclassified it as a core market, a long-term strategic necessity for their own survival.
Okay, let's tie these three massive threads together. The U.S. labor market's check engine light is on. China is dealing with a structural crisis, and conservative Japanese capital is making a huge aggressive bet on India. What's the final conclusion from this deep dive?
The big picture is a fundamental re-rating of global risk and opportunity. The first takeaway is about India. Conservative capital is now treating Indian consumer finance not as frontier risk anymore, but as a structural growth asset. That changes everything.
And the second point is about the global axes of growth.
Absolutely crucial. The world's growth engine is slowly shifting away from that old U.S. versus China rivalry. It's moving toward a U.S. plus India framework. This move by Japan is based on demographics, sure, but it's also a geopolitical hedge against the friction in China. Investors really need to rethink India's weight in their portfolios.
And finally, the opportunity within finance itself.
The third takeaway is that the smart money is shifting within the financial sector. It's moving away from the big traditional banks and toward these nimbler players, consumer finance, NBFCs, the data-driven models like Shriram that are actually capturing the growth.
A perfect summary. So for you, our listener, here's a final thought to chew on. The most conservative capital in the world, these Japanese megabanks, is making what looks like the most aggressive bet, going deep into Indian consumer finance. What does it mean when the institutions most focused on safety start prioritizing structure things like population growth over short-term volatile returns? It strongly suggests that the long-term structural flows we've talked about today are far more important than the temporary cycles grabbing all the headlines. Don't forget to subscribe and hit that like button.